Hello, this is Jim from Portfolio Insight. We produce Dividend Radar, the only automated and most accurate list of dividend champions, contenders, and challengers, and we publish it weekly on Friday. All of the metrics are sourced from Portfolio Insight's platform. Like many lists of dividend companies, performing additional research is an important next step. Using the October 20th edition of Dividend Radar, I filtered out several stocks and chose Stanley Black Decker as the topic for this quick take video. I will address two questions. Is this dividend champion a value trap? And is the dividend safe? Dividend Radar shows that Stanley has an attractive forward dividend yield, 4.08. The prior 5-year average dividend yield is 2.66. It is potentially undervalued and under its 12-month target price with a potential upside of 78%. So the takeaway is Stanley may be a buying opportunity. It's also a dividend aristocrat and recommended as a buy by some analysts and websites. Let's take the next step and perform some additional research. Stock price since May 2021 has dropped 65%. Trailing returns for Stanley minus 51.80 compared to the S&P's 28.14, clearly significant underperformance. And during the last 2 years, Stanley has increased the dividend by 1 cent per year. Next, we focus on the quality range fundamentals. The quality range is calculated by analyzing the historical values from a data set of top performing dividend paying companies. In other words, you learn what are the characteristics of the best performing dividend paying companies. It can be used to spot areas of strength highlighted in dark blue, which are above the quality range, light blue within the quality range, and gray below the quality range. There are 5 dimensions: performance, dividends, profitability, financial valuation. We're going to focus on the performance range for this. So comparing the total returns, dividend, EPS, and revenue growth, we can readily see that there's only one cell in which Stanley outperformed the quality range, which is in the 10-year revenue growth. 4 areas in which it performed within, but all of the remaining areas are highlighted in gray, which indicates underperformance. So the key takeaway, Stanley has consistently underperformed the best performing companies within the industrial sector. Next, we're going to analyze the dividend quality grade. It comprises 5 components: earnings, revenue, dividends, profitability, and financial strength. Initially, we're going to take a look at the narrative view, and in each case, the problem areas are highlighted in yellow. Here we can see that looking forward, earnings, according to the analyst estimates, are an issue. And we can see it also by the corresponding chart, these representing the analyst estimates. Same thing in revenues, an issue. Dividend outlook, because of the dividend payout ratio being 70%, which is above for the industrial sector. The return on equity, return on capital, and EBIT expense and net debt all are highlighted as problematical areas. We can change to the table view that supports the narrative view, and we can see at a glance which items are outside the quality range, highlighted here, So we can see negative payout. We can see the payout ratio 70%. We can see return on equity, return on capital. These are all of the areas that are evaluated, presented for further research, but also highlighted in the narrative view. Summarizing, Stanley is scored an F, which means that it's highly likely to cut or freeze the dividend within the next 12 months. Other sites seem to think that Stanley's dividend is safe. We do not. There are also several other risk factors that I'd like to highlight. First, that the CEO and CFO fiscal 2023 represents the first full year of their new role. The dividend aristocrat status may be under pressure, especially if Stanley cuts or freezes the dividend. And finally, consumer demand is deteriorated. Interest rates and inflation rates have increased significantly, but Stanley is unable to offset their increased costs with price increases. Key takeaway, we believe that based on the historical results and additional research and the dividend quality grade, that Stanley will continue to underperform at least through 2024. The conservative investor should view Stanley at this point as a value trap and likely to cut or freeze the dividend. Thanks for watching, and let me know what you think.